Right now, turn your attention back or focus back to the developed markets and bring you in on that one debate that is hogging all the headlines right now, and that is of nationalization of some of the leading financial institutions in America. Now, already the American government is a more than 80% owner in AIG, a 40% owner in Citi. Where do you stand on this entire nationalization debate, and what do you think are the likely consequences of so many institutions being nationalized?
I actually think the debate is off focus when we talk about nationalization per se. I've always thought of nationalization as long-term ownership, management, and control of a financial or non-financial corporate by the state. That is not what the United States, the UK, or European governments have in mind. What they're looking at is temporary injections of capital in order to stabilize these financial institutions and position them to return to global capital markets where their ownership base should obviously be centered. So I don't really believe we're talking about a major long-term process of nationalization. We're talking about temporary but substantial, I would acknowledge, injections of capital here. I think that there is an additional need for the governments to deal with the asset side of this problem, and that more force and more finance needs to be directed to cleaning the toxic assets and other bad assets off the balance sheets of these financial institutions. This may enable these institutions to return to the market sooner now than many analysts seem to contemplate. I would say, however, that it is crucial that the government reiterate and underscore its determination to move these financial institutions back in private hands.
Well, Mr. Dallara, though, one important worrying fallout of this nationalization debate is that many of these government-assisted banks, even those that were forced to participate in Top 1, are being forced to now lend only domestically. And what impact is that then going to have on global credit flows and globalization?
Well, I think you put your finger on one of the most counterproductive and, in my view, dangerous trends that we've seen in global finance over the last 6 months. And it's probably the most dangerous trend we've seen in global finance since the 1930s. I believe the world can ill afford financial protectionism, just as we paid the price for decades from the trade protectionism which erupted violently around the world during the 1930s. At this stage, though, I must say the early signs are not encouraging. And I think this is why all emerging markets, including strong leading ones like India, need to make their voice heard loud and clear as we approach this G20 summit, that this is not an acceptable or a sensible way forward. There is a misguided notion in the United States today that taxpayers want to disengage and lose the benefits of globalization, which have created so much wealth around the globe the last 3 decades. I think this is a misreading and, frankly, an underestimation of the fundamental sensibility of taxpayers around the world. They don't want all the credit just to stay at home. They want a functioning banking system and a growing global economy, and if we're going to get that, it will not revolve around constraints on credit at home, but around global finance being restored.
All right, one final question to you, Mr. Dallara, and that is your views. Based on your views on nationalization, can I assume that you are not part of the growing number of voices that believe that some of these institutions, such as AIG, should be allowed to fail, and that government should not artificially prop up these institutions, because if we don't let them fail, we won't let the rot out of the system at any point in time? Do you think we can even imagine allowing an AIG or a Citibank to fail?
I don't believe so. I think that if there are a growing number of voices, in my view, they're misguided voices. We should have learned from the experience of Lehman that letting a major financial institutions in today's globally interconnected world fail has inevitably unforeseen, very powerful negative consequences. The single most devastating event of the last 16 months has been the decision to allow Lehman to fail. And in my view, it catalyzed a spiral of deteriorating confidence among consumers, investors, businessmen around the world. And we're still, frankly, trying to recover from this. The last thing we need, in my view, is to allow another major financial institution to fail. I think what is being missed in all of this is that financial institutions, including the two you mentioned, are steadily putting into place the corrective measures that are needed to ensure that these institutions can go forward as viable financial institutions. New methods of governance, new methods of risk management, new forms of compensation, new forms of transparency, all of which should enable these institutions to move forward. What is lacking is a cleansing of the balance sheet. If we are able to muster the courage, the political will, and the financial wherewithal, which can be afforded if we stretch the cost out over many years, 15 or 20 years, then the governments of the G7, the G10, need to direct serious financial strength toward cleansing the balance sheets of these financial institutions. At the same time, this, along with perhaps in a few cases, further injections of capital or conversions of capital from preferred into common equity, as we've seen already with Citi, could set a new course that can reattract private capital, in my view, in fairly short order. I think I would make one last comment here, which is that I think that many of these financial institutions are actually also disposing of assets, trying to position themselves for a future that can be viable if they have adequate government support for cleansing the balance sheet. Finally, as part of this process, we need to take a hard look again at the application of fair value accounting during a time of illiquidity in certain segments of the capital markets. I think this is one piece of the problem that has not received enough attention. We're strong supporters at the Institute of Fair Value Accounting, but when you have illiquid market conditions, to allow the mark-to-market prices derived from very scant market-based price data to continue to hammer and drive down the earnings positions of major financial institutions, in my view, requires a serious global high-level dialogue, and we would hope that that can happen sooner rather than later.
All right, Mr. Dallara, a dialogue that's already taking place when it comes to mark-to-market. Let's see if MTM is going to live a short life. But thank you very much for joining us. Charles Dallara there of the Institute of International Finance, speaking to us from Washington, D.C. While we're